has picked up. Okay, here we go. And I will go back into my share and keep going here. Okay. All right, so I'm going to keep moving forward, and then we'll catch up on the Q&A at the end, or when Whitney gets back in. So this kind of goes along the lines of what we were just talking about, when to reassess the lease term. So, you know, kind of along the lines of that question about the 25 years. So you reassess the lease term, and this is, you know, obviously in the perfect world, you're looking at this all through the year and looking at your leases whenever any event happens. But really, we know in reality, you're going to be looking at your leases once a year, right? When you're preparing for the closing. Oh, thank you, Stephanie. I'll have to figure out how. 1 second. Hide presenter view. Sorry, we're just having a little technical difficulty here. Let's see. My share went away. Let's try it again. We are on slide 12 on the current slide. Okay. Can you see the notes now? Okay, I think we're okay. All right, so in reality, you're looking at this once a year or maybe twice a year, hopefully, you know, especially for those of you that have a lot of lease activity, you might want to do it more often than the once a year, because you won't get everything done as part of the closing. So the question is when to reassess the lease term. So at least on an annual basis, but maybe more than that for those of you that are looking at it. You want to, you reassess the lease term in the event that, like, if there was an option elected that you were not previously certain. So you didn't know if you were going to elect it, but now you've decided that you are going to move forward with some of the options. So you may have to reassess the lease term. And then, of course, on the flip side, the opposite. If you decided we are not going to extend this lease, we're not going out the 25 or 50 years in the future, we're going to terminate it at the end of this lease term. So then you reassess the lease term and make the adjustments at that point. And then, of course, if any event that requires extension or termination occurs, then you need to reassess the lease term as well. So short-term leases. Short-term leases are anything that's 12 months or less. So in the year of implementation, that measurement period starts at the beginning of your fiscal year. So it's either January 1 or July 1 of the beginning of your fiscal year. So as I mentioned earlier, it doesn't matter if you had a 50-year lease. If you're in the last year, you're in year 50 at the beginning of the fiscal year, then it's going to be less than 12 months. It's considered a short-term lease and not subject to 87. But remember that that 12 months or less term includes any options to extend regardless of the proper, in the short-term lease, it excludes any options to extend regardless of the probability if it's considered a short-term lease and you're reasonably certain you're not going to extend. So other factors to assess when you're looking at your lease term, it's the other factors that allow for termination, you know, the purchase of the underlying asset. If you're sure that you're going to purchase the asset at the end of the lease, then it's going to be recorded as a finance purchase. Your normal, what used to be called the capital lease. Recorded as debt, record the capital asset. If there's another termination for the payment of all sums due, or default on payments that are not considered, default on payments are not considered termination options. That's not part of the termination on the default. If you're going to default, that's a whole different issue. All right, so we're going to launch polling question number 1. I can't launch it. Stephanie, are you able to launch it? There we go. All right, so polling question number 1. What is considered a short-term lease? So 24 months or less, 12 months or less, 18 months or less, or 36 months or less. Hopefully you can all remember 2 slides prior. Whitney will rejoin us in a few minutes. She has to restart her computer. All right, we'll just let it go about 10 more seconds here. All right, great. So let's share the results. So great. All of you got it 12 months or less. It's a short-term lease. So those are, once you assess that lease, not subject to 87. Great. All right. So now we're going to talk about the accounting for the leases. This is where we get into the complex piece. The term, there's a lot of components that go into accounting for the term, but the actual accounting is when you're going to figure out what you are going to record. So the lessee, of course, is the entity who, in exchange for a payment, takes the temporary possession of a property, you know, or a non-financial asset through a lease. The lessee is going to record a lease liability offset with an intangible right to use lease asset at the beginning of the lease. So at the very, whether that be, again, beginning of your fiscal year and the year of implementation, or during the fiscal year for as we move forward and you have new leases that come into play, the lease liability and the intangible right to use asset will equal each other. At the beginning, they equal each other. During the year, they have different amounts because they're going to amortize at different rates. Then the lease asset is amortized over the life of the asset or the lease term, whichever is shorter. So that's where you get that. And then in full accrual funds, the lease asset and the lease liability are recorded in your full accrual funds, such as enterprise and internal service funds, and then also recorded at the entity-wide. So the lessee is going to be recording things only in full accrual funds. And so enterprise, internal service fund, and then entity-wide statements. Now that lease asset, the intangible lease asset that you're recording is going to be reported in with the capital assets in the capital asset footnote, excuse me. It'll be a component of that. And we're going to go over some visuals of what those look like at the end of the presentation. So that, how do you calculate the lease liability? At the beginning, it should be measured at the present value of the payments expected to be made during the lease term. In subsequent periods, as payments are being made, the lessee should calculate the amortization of the discount on the lease liability and report that amount as what GASB calls an outflow of resources, such as interest expense for the period. And then any payments should be made first to the accrued interest portion and then to the lease liability. So a standard amortization schedule. So if variable payments are based on an index or a variable rate, that's where it can get pretty confusing. What, you know, those payments in the future, if they're going to increase, you know, say every 5 years, they go up by a CPI or some other component, you're going to use the rate or the index at the time of the calculation. You're not required to remeasure every year in the future. It's at the time of the calculation. What's that rate in place? And you use that to do your calculations for the payments that are due in the future. And the last 5 components that are shown here on the left of this slide, starting with the residual value guarantees through the other payments. So those items should be included in the calculation only if you're reasonably certain that the event will occur. A residual value guarantee, that's a promise made by the lessee that the lessor can sell the leased asset at the end of the lease for a guaranteed amount. And for the exercise of the price of the purchase option, the payments for penalties for terminating the lease if the lease term reflects the lease. Wow, I can't say lease and lessor anymore. Lessee exercising an option to terminate the lease or a fiscal funding or cancellation clause. So future payments measured as part of the lease liability should be discounted using the interest rate that's implicit in the lease, either explicit or implicit in the lease. If the interest rate cannot be readily determined by the lessee's estimated incremental borrowing rate should be used. So that's one of the biggest questions we get. How do you figure out what your incremental borrowing rate is? GASB suggests that you ask your bank what your borrowing rate would be. I suggest obviously that as well, but it doesn't mean that you need a rate. You know, you don't want to have to ask your bank for a rate for each individual agreement. You may be able to ask the bank what's a long-term rate and a short-term rate and match that up with your various agreements and how it would apply. And again, for including things in the lease liability, again, that key about reasonably certain the event will occur is how you determine whether or not these items get included in the calculation of the lease liability, and then you discount it from there. The lease asset. So again, at the commencement of the lease, it's going to equal the lease liability. but then it's also going to include any payments made to the lessor on or before commencement, plus certain initial indirect costs. So any initial indirect costs include ancillary charges necessary to place the lease asset into service. You're going to include those into the calculation of the lease asset. And then you're going to amortize that over the shorter term of the lease itself or the underlying useful life of the underlying asset. Hopefully they're similar, but sometimes they're not, right? The asset may have a longer, well, if it has a longer useful life, then you're going to use the lease term, or it could be the opposite. All right. Now the lessor. So what does the lessor need to do? So the lessor is any entity who in exchange for payment provides the temporary possession of the owned property through the lease. So the lessor owns the asset, has the asset on its books recorded as a capital asset already, but is now going to lease the right to use that asset to another entity. The capital asset accounting for the lessor does not change. That continues on. The asset stays on the lessor's books and continues to get depreciated over time, depending on what, you know, if it's not land. So one fun fact here for those of you who've been trying to avoid learning about deferred outflows or inflows of resources, you can't anymore, because you notice you have it on the lessor offset. Wow, brain just went off for a second. You're gonna have a lease receivable, and then it's offset with a deferred inflow of resources. So those are going to, similar to the lessee accounting, those are going to equal each other at the beginning. Lease receivable, deferred inflow of resources. And again, as I mentioned, you're not going to retire the asset. As payments are made, you're going to recognize that interest revenue on the lease receivable, amortize the lease receivable in accordance with the amortization schedule, and the deferred inflows of resources gets amortized over the term of the lease. And then you continue to amortize the capital asset as mentioned.
And Amy, we do have a question.
Sure.
If the lease agreement has a purchase option of $1, does it mean the lease is not subject to GASB 87 since it's actually purchase financing?
Agreed. So yes, if you really, and if it has the purchase at the end of the lease of the dollar and you intend to exercise that, it really is effectively a capital, or excuse me, I have to get rid of using that, the old capital versus operating. It really is a financed purchase arrangement. You really are buying it at the end. And yes, you would record it as debt and record the capital asset. Agreed. Good question. No. Okay. So how do you record the lease receivable? So initially, you're going to measure the lease receivable as the present value of lease payments expected to be received over the lease term, reduced by any provision for estimated uncollectible accounts, which hopefully you don't have an estimated of uncollectible accounts, but it could happen. And then future lease payments are measured as part of the lease receivable, should be discounted using the interest rate that the lessor charges the lessee, which could be the rate implicit in the lease or explicit. And you're going to use that as the discount, and that's your lease receivable. The deferred inflow is going to equal the lease receivable plus any payments received on or before commencement, and you're going to amortize it over the life of the lease. In subsequent periods, you're going to calculate that amortization and record interest revenue as you retire. You know, as you amortize that lease receivable, you're going to record interest receivable for the period, and then the difference goes to the principal of the lease receivable.
Amy?
Yes.
Do we record 6-year power purchase agreements for solar panel systems as a lease?
That is a darn good question. So it depends on, yes, if they're power panels, I know some of those are installed on your buildings and you don't own them, you're just leasing them. So again, it's a non-financial asset that you are leasing. And at the end, if you don't intend to purchase them, then yes, it would qualify under 87. And I don't think the six-year question matters, because it's more about the, you know, what's your intent? What are the full terms of the agreement? You know, and I do have to give the one caveat, you know, when we're giving these answers for things like that, these answers are without seeing the actual agreement in the terms. So this is, you know, based on the limited information you're providing and the general answer on what the general thoughts are and whether it would be subject. You know, it's going to be those components of non-cancelable, You don't intend to purchase it at the end. You don't own the solar panels in this case. And again, that term, the 6 years, is it at the beginning of the fiscal year, you have more than 12 months left on the lease in the non-cancelable period. Great question.
And then there's also another one, Amy. I'm back, by the way.
Okay, great.
Fell
Welcome
into
back,
the crevices of earth. Okay, to clarify, if we have a 5-year lease for a sweeper and intend to buy it at the end of the lease term, do we include under GASB 87?
No, then that's going to be a finance purchase. Yes, anything at the beginning when you're doing that initial measurement, you intend to exercise the right or the option to purchase at the end, you're going to count that as a finance purchase at the beginning of the lease term.
And that's it.
Okay, great. All right, so then there's some other considerations we're going to talk about here. We're not going to go into too much of the details for these, but we want to make sure that you're aware of the topics, because they do happen, but they're just not that common. So other considerations include sale leasebacks. So a qualifying sale is required, otherwise it's considered to be a borrowing in that case. And you're going to account any sales and leasebacks as 2 transactions. You account for the sale transaction and then the lease transaction separately. And then of course you have to disclose the terms of the lease arrangement. And there is separate guidance in the GASB for leases with or between blended component units. That internal leasing activity would be eliminated. If you have, easy example is a financing authority. If you have a financing authority, if it issues separate financial statements, even prior to 87, the financing authority usually records a lease receivable or some sort of asset, intangible asset, and offset with the debt or some other in the fund level, depending on if it's an enterprise or a governmental financing authority accounting, may have been offset with a deferred inflow of resources in that separate report. And when it's blended into the primary government's financial statements, those activities get the transaction between the entities gets eliminated. That accounting doesn't change. 87 still says the same. So if your financing authority does not issue separate financial statements, it's blended, then you're never going to see that lease receivable and lease payable. You just boil it down to the asset and the debt payable. So lease modifications. So of course, lease modifications are going to happen, right? And these are things you want to remember and pay attention to. And that's where something we're going to talk about in a bit is that, you want to start developing some policies and procedures around leases, because things are going to happen during the year. Who's going to be in charge of monitoring your lease transactions to be aware when there are modifications? How are you going to know? How are you going to be informed to make sure that the accounting is appropriate? Because you could have accounted for a lease 3 years ago. That lease has been canceled. And that's probably not a good example because you would know if the payments weren't being made. But that accounting, something has been changed. There's been a modification or amendment to the lease. If you're still accounting for it under the original lease terms, it may be inappropriate. You might not be accounting for the lease based on what the current activity is. So if there are any lease modifications, from amendments to the lease contract, not from exercising options in that contract. So these are modifications that are actual changes to the lease agreement, not just exercising the existing terms. Those are considered modifications unless the lessee's right to use the underlying asset decreases. So a termination, something could be considered a partial or a full termination if the lessee's right to use the underlying asset decreases. So if that happens, then you might have to terminate the lease accounting, depending, either partially or fully. And you report any modifications as a new lease by the lessor and the lessee if new assets are added and they're not unreasonably priced. If if neither of those components come into play, then you have to remeasure the existing lease. If those are in place, then you have a new lease for the lessor and the lessee. Remeasuring modifications comes into play when the lease liability on the effective, you remeasure the lease liability on the effective date of the modification. So it could be mid fiscal year. It doesn't mean you start at the beginning of the fiscal year. This year of implementation is only the time when everything starts at the beginning. Anything else happens on the day that it is effective. And you're going to adjust the right to use asset to the new revised amount. And if the change results from the lessor refunding any related debt and passing the savings on to lessee, there's separate guidance for that. So you want to follow that if that happens to case. I don't think that's going to be too common, but you never know. And so for the terminations, if it's partial or a full, the lessee is going to reduce or remove the lease asset or obligation, depending on whether it's partial or full, and you're going to recognize the difference as a gain or loss. And then, of course, if the lessee purchases the asset, you're going to reclassify it to the appropriate asset class.
And Amy, we have one more question on basically the finance purchase lease. Can you please confirm again whether or not a capital asset that is purchased on a financing arrangement needs to be recorded as a lease under GASB 87? An example would be a vehicle purchase to be paid over 5 years.
No, that would be recorded as you are currently, prior to 87. If you had that leased purchase, you recorded debt and you recorded a capital asset. That is the accounting that would be, your normal. I'm going to call it normal, even though GASB 87 is going to be normal before we know it, but that's going to be your normal or your regular accounting for the lease purchase. All right. So the next few slides, I'm just going to breeze through them because this is one of those things that I wanted to provide the information for you. Again, at the end of the slides, I've got the link to the to this, because these are 7 steps for determining. And again, you can have more steps, you can add more, but this is kind of 7 basic steps to assist you in determining whether a lease is subject to 87. And hopefully this will help answer some of those questions. And that's why I want to point you to the government industry alert. Again, it's a non-authoritative document, but it was developed and based on the provisions of 87. So it is a good tool. It's got determine whether you have a contract. Obviously you got to start with something. Is it writing, verbal, or legally binding? If it's not legally binding, no, you just stop right there. Does it convey control? I'm going to go through these pretty quickly. Is the item a non-financial asset? If no, it's not subject to 87. If it's a financial asset, it doesn't apply. Other guidance applies in these situations. Is it an exchange or exchange-like transaction? So in footnote 1 to 87, it indicates that the difference between an exchange and exchange-like transaction is a matter of degree. So in contrast to a pure exchange transaction, which is that in which equal value is given and received, an exchange-like transaction is one in which the value is exchanged, though related, might not be quite equal, or in which the direct benefits may not be exclusively for the parties to the transaction. It's a little confusing to say that, but it means the exchange characteristics of the transaction are strong enough to justify treating the transaction as an exchange for accounting recognition. That's why they use that exchange-like. Is it close enough to being that in which equal value is given or received? So that's a key component to the statement as well. And then there are we talked about the scope exclusions. These items are excluded because they're subject to other GASB guidance. So if the lease agreement or the asset under the lease agreement is in any of these categories, then it's not subject to 87, it's subject to different guidance. And then of course, short-term lease. I think also step 6 could be pushed to the front. If it's short-term, then you don't even have to go through the other components, but because you have those options to extend and things like that, you might wanna, that's why it's considered here at step 6. And then the finance purchase. If if the ownership is transferred at the end of the contract, or you're going to exercise that purchase, then you treat it as a finance purchase. All right, polling question number 2.
Hey, I will release poll 2.
It's a hard one.
Ooh.
It is difficult.
Where do you get your morning coffee?
I got mine from home.
I'm impressed by the no coffee for me response.
No, I'm thinking that's probably replaced by something else like tea, or I guess we could have included tea in this question.
Or energy drinks.
Energy.
Or Diet Coke.
Yeah. Oh yeah. You were encouraging a lot of Red Bull. All right. With it. End the poll.
End the poll.
All right.
So most of you get your coffee at home.
Yeah.
And the rest, no coffee for you. Must be nice.
Yes.
Saving some money there.
It should have included the next question of whether the coffee at home was different pre and post pandemic.
Oh, if it was like purchase versus making.
Yeah, in the past. Yes. All right. All right, so I'm going to skip this. We're going to look at this at the end if we have time, because we're working on a calculation worksheet to assist in that calculation of the initial liability to include some other components, but I'll flip over to that to the end because I want to get through some of the other slides as well. So your disclosures, because this is the next component. Once you've figured out what your balance that you're going to record, what do you have to disclose in the financial statements? So for the lessee, you have to disclose a general description of the leasing arrangement. You know, you have some of that generic discussion of leasing arrangement, and then also specific to the agreements. And if you have a significant number of leases, you can boil them down, include them more in a summary form, combining different components together. But you want to have at least the existence, terms, and conditions of any residual value guarantees that are provided, and the general basis, terms, and conditions on when the lease on which variable payments not included in the measurement are determined. And then, of course, you have to include the total amount of the lease asset and related accumulated amortization. That's going to be disclosed in the capital assets note. It doesn't need to be in the leases footnote if you have a separate leases footnote itself, but they have to be separated from capital assets. And we'll get you some visuals from that at the end. Then also you have to include the amount of lease assets by major, oh, that's a double up. An amount of outflows of resources recognized in the fiscal year. You only have to include that in a note disclosure if it's not on the face of the financial statements. You also need, then these are all the lessee disclosures. You have to include the amount of outflows of resources recognized in the fiscal year for other payments, such as residual guarantees, termination penalties, anything not previously included in the measurement of the lease liability. And then principal and interest requirements to maturity. So the lessee has to include a schedule of principal and interest requirements to maturity. So your liability payment is similar to that schedule, you know, your debt amortization schedule that shows in the footnote. So it's each of the 5 subsequent years, fiscal years, and then 5-year increments after that.
And Amy, we have a question in the chat for, it's a 2-part question. The first is, do we amortize the land leases?
No, you do not. So normal capital amortization, the lease itself, there's different rules. So the lease asset will not be amortized. Wait, I'm saying it backward.
You mean the land, sorry, the intangible piece of the.
I guess I'm trying to figure out which one, if you're a lessor or lessee, but you're right. The normal rules apply. If it's for the intangible lease asset will not be amortized, but the lease liability will be amortized in accordance with the terms of the lease.
And then the second question is, do we count all copiers under GASB 87? Each copier charges under $200 per month from a different company.
Right. And that's where you're going to have to look at, you know, it's that normal question about whether you're going to gather your, it's kind of like your capital asset. And that's where you want to develop some policies and procedures around it, because do you consider each individual lease, or excuse me, asset, or is it all of the assets under the lease agreement? You know, kind of like capital assets. Do you capitalize each individual computer, or is it all of the computers as a whole because the cost was above your capitalization threshold? So that's where you want to develop policies and procedures around specific to leases.
Okay, perfect.
So some additional disclosures for the lessee include commitments under the leases that are before the commencement of the lease term, anything that you needed to do before the lease term, and components of any loss associated with an impairment. If the asset becomes impaired, there are disclosure and accounting requirements related to that. So that's something you want to factor in each year and look at as well. So there's a few more disclosures here. I'm not going to go into the details for these because they're not very common, but you want to look at statement 87 because it has easy to follow disclosure requirements if you have any of these situations. All right, then the lessor. So the lessor has requirements here. So similar to the lessee, general description of the leasing arrangements can be grouped for purposes of disclosure and including basis in terms. The amount of inflows of resources, so how much was collected, recognized from the fiscal year, if not displayed on the face of the financial statement. So I think for most of our clients, you're not going to have a line item that says lease revenue or whatever your inflows were. But if you do, then you don't need to include it in the note disclosure. If you don't have it on the face of the financial statements, then it needs to be in the note disclosure. Then the amount of inflows of resources recognized in the fiscal year for any variable payments that were not previously included in the measurement of a lease receivable. So if you have any variable payments that for some reason were not included, then you need to disclose that in the note disclosure. Existence, terms, and conditions of options by the lessee to terminate the lease with or abate the payments, because that's where it comes into play with linking to that question that was earlier. If there are some options that you're not sure if they're going to exercise it, you need to include those in the note disclosure, because that's where it could change the accounting in the future if they were to exercise something. Because again, you can't make the decision. You as the lessor can't make the decision for the lessee. And then additional disclosures, if applicable. There's a couple slides on this. You know, if you have any regulated assets, sublease transactions, things like that. And if applicable, if the entity's principal ongoing operations consist of leasing assets to other entities, then you need to include the schedule of future lease payments in the subsequent 5 years and each 5 year after. Wow, I can't say it in English anymore. So similar to the lessee disclosure where they had to have the debt schedule, if the principal ongoing operation of the entity, again, going back to the financing authority example, for a financing authority, its principal ongoing operations is to issue debt and lease, you know, enter into a lease. So it would have to include that, I'll call it maturity schedule for that lease receivable, but it's not required if it's not the principal ongoing operations. So most entities are not going to be required to include a maturity schedule for the lease receivable amortization. And then regulated leases. So certain leases are subject to external laws of regulations or legal rulings, such as Department of Transportation or FAA leases. So if you have any of those, you want to look specific to those required disclosures. They're, again, not too common with our clients, but I know that you know that they're out there, so you want to look at those requirements specifically in the statement. And there's a couple slides on that and additional requirements. So we're going to go over the disclosure example later. Hopefully we'll have time to get to it. I'm trying to speed through so we can get the visual of it. But we've put together using the GFOA's example ACFR in one of our clients' footnotes. We've developed an example disclosure. It kind of shows the different places in the financial statements that need to be updated and revised for the implementation of leases. And we can share that as well. You know, it's not not authoritative, and everybody's financial statements look different, but it kind of shows you the places that it hits. And then the other thing to look at is GFOA's checklist. You know, the checklist that they use for those of you that participate in the ACFR program, that's the checklist that they use to grade your report and determine whether you've included all the required disclosures. You can go to section 12 of the checklist from GFOA's website, and that's specific to leases, has all the required, the basic requirements. Of course, it's not going to hit on everything specific to you and your agreements, but it's going to have the general requirements that need to be included. All right, polling question number 3.
All right. I am going to launch. True or false? All lessors and lessees have to disclose principal and interest requirements to maturity.
Based on the answers coming in, I see I have completely confused a lot of you on my stumbling language here, but we will talk about the answer.
Well, it's hard to, I guess for us it's different because we've talked about it so much, both sides of it.
Yeah.
But it's hard to put on the lessee versus lessor hat.
Exactly. So we can end the poll. It always kind of
okay. Ending the poll.
All right. So most of you said true, and the answer is actually false, which funny enough on the slide, you can see it's bright red there. So the answer is false. All lessors and lessees are not required to disclose principal and interest requirements to maturity. Lessees are required to. Lessors only have to include it if it's the primary purpose of the entity to issue leases. So it's not a requirement if you're a lessor and you're just a city and you just happen to be leasing something to another entity, you're not required to include the principal and interest requirements to maturity. All right. I hated true false questions. I never could get them right when I was had a history teacher that loved true false tests. All right, it was pure torture.
Yeah, I never did well in history.
No. Okay, let's see. So financial statement presentation. Wanted to give you the visual of what's it going to look like. Where is it going to hit in your financial statements? So we snipped these snips that you can see. I know they're a little small for you, but they're from GFOA's example ACFR. And for those of you that don't know what that is, you can Google GFOA Appendix D, and it's an example ACFR that GFOA, they used to put it in the middle of the Blue Book, but now it's online and electronic because they want to be able to update it as new GASB statements are issued. And so these snips where you can see on your balance sheet, you're going to have, and whether it's a governmental fund, enterprise, any fund, if you have a lease receivable, you're going to be recording that lease receivable in the fund, any fund, and offset with the deferred inflows of resources. And in this example, it's titled lease related. And then if you, on the other side, for the full accrual funds and the entity-wide statements, you're going to have a lease payable. Now, the component or where it's going to go is going to depend on what the titling of your non-current liabilities are. Some of you, it's going to be on its own line. Others of you, it's going to be in a line called long-term debt and long-term liabilities, something along those lines. It's going to depend on the presentation that you provide. But then on the flip side, the asset offsetting the lease payable is going to be in your capital assets. That's going to be that intangible asset. It's going to be hiding in the capital assets. It's not going to be discreetly, for most of you, not going to be discreetly presented. On the statement of activities, nothing is discreetly presented on the statement of activities. There's no, that's your income statement or in the statement of activities at the entity-wide statement. And I got ahead of myself a little bit when I was talking about the balance sheet. This first page was for this first tab was for the statement of net position, and I got off tangent and talking about governmental funds. So governmental funds balance sheet, that's where you're going to show lease receivable and offset with the deferred inflows for when you're the lessee, or excuse me, the lessor. Speaking backward, and then you'll also have a reconciling item for any leases payable if you have those, if you're the lessee, goodness. And governmental funds income statement. So in the year of issuance, you're going to treat these leases just like you do debt, the issuance of debt. You're going to have a line item for another financing source in the year of issuance of the lease. So in the example ACFR for GFOA, their lease was $57,000, and any payments on the lease are included in expenditures using debt service principles. So normally you're going to have principal retirement and interest expense. And then you're going to have a reconciling item on the income statement, the statement of activities reconciliation in the year that there's a lease issued. And then, of course, your enterprise, I didn't give you separate snips for the enterprise fund because that's going to be similar to the statement of net position, the entity-wide statements, snips that you saw there. So in the implementation year, again, it's no longer in the future. You're here, we're here, no more avoiding of it. So how do you prepare for the implementation? I know we sound like a broken record when we talk about it, but you want to inventory all your current agreements. And when we say all, you really do need to inventory all of them. Don't just look at them and decide that you're going to, okay, this one's not subject and not included on your inventory. Include everything, because you want to be in the future when you run across that agreement to not have to rehash what your decision points were. Now you run across it in the future, it's on your inventory. You made your decision, and it is or it is not being recorded. And I have clients that have started this, that have one inventory with everything on a schedule. I've seen clients that have an Excel schedule where they have one tab for the agreements that are being capitalized versus the ones that are not, but at least everything's together, so you have all of your agreements in place and your decision points in one place. And as Whitney mentioned earlier in her class earlier, as you go through this process, when you run across those subscription-based information technology arrangements, knowing you're going to have to go through the same process next year, not that you have to make a perfect inventory this year, but as you run across them, start your inventory for that implementation, since that's going to be coming in fiscal 23.
you have a couple questions when you're ready. Okay. So there's one that's, we have a lease only charge $1 a month. Can we recognize it as a loss? If so, how do we determine the market value?
The lease is only $1 a month. Can we recognize it a lot? I'm going to assume you meant recognize
That
it
there's
as a
no,
lease, not recognize it
maybe
as a loss.
maybe it's recognized it as a lease.
As a lease, yes. So that is not an exchange or exchange-like transaction. $1 a month, not an exchange or exchange-like. Doesn't matter if it's $1 a month, $1 a year, probably even $1 a day. You know, $365 a year is not going to be a market. It's not an exchange or exchange-like transaction. The value that that entity is giving and receiving is not equal, and so it's not subject to 87. It does not fall under the terms because it's not. You know, but again, you want to include it on your inventory because then you have addressed it, recognized it, and you can move forward, and you don't have to reassess it each year as you go through this process.
Okay.
Go ahead.
Shouldn't the lease receivable amount and the deferred inflows amount, so that would be as lessor, wouldn't the receivable and the deferred inflows amount be the same on the balance sheet?
No, they will at the beginning of it. So that example balance sheet we were looking at was the end of the fiscal year. So their amortization has happened at the beginning of the term. Yes, they did. But at the end of the year, they're going to not be, because one is being amortized over the, being amortized using principal and interest expense at the discounted rate, and the deferred inflow is being amortized straight line over the shorter of the life of the lease or the life of the asset.
Mm-hmm.
Yes.
Okay.
All right. So other things you want to do as you go through this process, you have to develop a system of internal control. You know, that's how decentralized is your contracting department? How are you going to know what leases are out there? How will you ensure that you've incorporated all the leases into this process? You want to also determine, which leases fall under this statement. That's why you want to have to come up with those policies, procedures, dollar thresholds for capitalizing. What are you going to do? We talked a lot about that, and who's analyzing the agreements. And then you also, think forward. This is not a one shot. This is a moving forward item. Who's going to be responsible for, what are you going to do when you encounter new agreements and modifications that happen during the year? How you have to develop those procedures and policies to make sure that you're catching everything and you're going to be accounting for things on an ongoing basis. It's a new area for you. Then remember, you're going to restate. You're going to restate the financial statements at the beginning of your fiscal year. But again, the net effect, because those beginning numbers should equal each other, the net effect is expected to be 0. There might be, depending on the components of the calculation, there could be some other components that fall into it where maybe they don't, but the net effect is generally going to be 0. It doesn't change the prior treatment of any existing capital leases, lease financing arrangements, so those don't get restated. So the items that, there are tables in the footnotes that need to be restated. The beginning balance of capital assets table, because you're going to have that new line item for your intangible lease asset, and you're obviously going to have a beginning balance of a leases schedule. You're now going to have a new schedule that shows leases, beginning lease payable or lease receivable activity during the year, and the ending balance. And then if you have comparative financial statements, you're going to have to restate the prior year balances in the financial statements. You're only required for fully comparative statements. The restatement is required unless not practicable. So you want to take that into consideration if you have fully comparative. If you don't restate the fully comparative financial statements, you have to disclose the reason for not restating. And then something else to think about, you have to decide whether or not you're going to restate the MD&A tables. And if you don't restate them, then you should add a footnote disclosure on the MD&A tables that indicates they have not been restated for the implementation of the statement, because that's going to mostly affect the statement of net position table. Polling question number 4.
Right. I will release.
We have 4 minutes.
Which type of agency do you work for?
We were just curious. All right. Great, so we got a good mix here. And welcome, everyone. Thank you for making it through these classes. All right, I'll end it.
Share results.
All right.
City is most common, 65%, and then special district with 22%, and then other and county.
Great. All right. So we're going to go through a couple calculations. I had 4 on here. I'm only going to go through a couple here because we are running close to the end here, and I'm not going to get to everything I wanted to go to. So below are, so we have 4 scenarios. So we're just going to talk about the why and the what. So like this first example, you have a contract for equipment, the commencement perfectly, and these are simple examples. Commencement of July 121, a 60-month non-cancelable term. There is an option to extend for 24 months. It may be continued on a month-to-month basis after that. It's cancelable. Base monthly payments $1,000, which includes 200 use hours. Excess hours are $5 each, $80 monthly payment for repairs. 4% interest rate is built into the agreement, pretty rare. Or actually not pretty rare, excuse me. Separate contract, there's a separate contract for delivery and installation costs. So the lease term, the non-cancelable term would be 60 months. Do you include the option to extend? Only if you're reasonably certain it will be exercised. We talked a lot about that. Do you include the month-to-month term? No, because it's not enforceable. So therefore, the lease term is 60 months. So in this simple example, the calculation of the initial lease liability here is $54,480. And then in this case, you are going to include some initial direct costs. So the lease asset, there isn't going to be at the beginning of the term. I know I said it a lot of times that they're going to equal each other. But if there are these other components that then they're not going to equal, so there would be a restatement. So sorry, I forgot all about that component to it. So you can see the initial value of the lease liability, $54,480. There were some additional costs to get it in place. So it cost $55,000 for the lease assets. You're going to have a lease asset of $55,980 and a lease liability of $54,480. Now, again, this is discounted 4%. This is where the payments are equal amounts. As you know, most lease contracts have, again, scaling or CPI factors that come into place. So the amortization schedule is going to get a little messier. Example 2, this is the easy one. This is the dollar. I'm going to skip to the answer on this one. This is the dollar. The base monthly payment for this lease, it doesn't matter about all those terms. The monthly payment is $1. Market rent's $450. It's not an exchange or exchange-like transaction. So skipping to the answer, no, it's not subject to 87. It should only be, the value received and given is not equal. Then I'm going to skip ahead here. These, sorry, we're not going to have time to go over these. Wanted to just give you, I didn't plan on going through these slides. I just wanted to give these to you. Again, these are example checklist requests that we will be including in the interim and or closing checklist, because there's a lot of work that has to be done. This is a whole new audit area, right, that we have to address, and you have a whole new area. So these are examples. They're going to be customized if any decisions have been made. This will kind of be the first generic one that you're going to get. You'll notice number 6 here, a GL report of the revenue and expenditure and object codes, because we're going to pick transactions that are in those lease accounts to see if the lease agreements are on your inventory. And so that's why we say for your inventory, you want to have it a full inventory, because if we pick one and it's not on the list, then we think that you know, did you ignore it, or is it that you made the decision? You want to have that trail of your decision of whether something is subject to 87 or not. And again, it's going to help you in the future. So if someone on your team runs into a lease agreement and finds lease, it's not like it's a brand new lease agreement. So that's why you want to have that full inventory or list of your agreements. Again, I'm skipping through these because I just wanted to provide them to you so you had an example of the interim and final checklist requests. And then audit procedures. So again, the extent of audit procedures, that's going to vary from client to client depending on the number of leases included in the inventory documentation and the volume of transaction. So in fiscal 22, the first year, our audit scope has to expand to cover this new audit area. We have to subject, you know, we're going to subject your full inventory to testing. And, you know, we're going to test for things like, is the inventory complete? We're going to, again, select those revenue and expenditure transactions. Look at the lease agreement. Do we come to the same conclusion that you did, whether it's subject to or not subject to 87? Then, of course, we're going to test the calculations. Do we come to the same conclusion in what the lease asset, lease liability, you know, that we come to the same calculate the same amount as you. And we're going to, of course, test the footnote disclosures. And then in years subsequent to the year of implementation, we'll continue the same testing, but of course, it's going to be on an ongoing basis for new lease agreements, you know, kind of like debt and capital assets, where you test the activities for the year. And we're still going to look into those revenue and expenditure accounts, looking for new transactions that may or may not have been caught by the client. All right, and I'm going to skip. No, I want to go. We'll do polling 5, and then we're going to be done. I want to do polling 5 because this is going to tell us where you stand. We hope, you know, we've been talking about this for a long time. We've been talking about this. Is not the first time a lot of you have gone through this process. So where do you stand in your preparation for the implementation of 87? Not started. The answer to that one is, oh no, because it got, you know, it's there. Your fiscal year's even over, right? You've passed June 30. So I'm glad to see that a few of you are done, and you know, and appreciate that you came to this class, even though you're done, because and hopefully we provided a little more information or some information to confirm some of the decisions you may or may not have made. And so those of you that are not started, we suggest you know, get that lawnmower going, pull the chain and get that engine going and get started on that, because and that's why the government industry alert was alerted, you know, that it was issued, that the auditors, you know, if we can't get in there and audit what you've done, it's going to impact the year-end audit, because it is a new audit section, and we want to make sure that everybody has time to do the testing, make any adjustments, do the calculations, see what needs to be done. So we'll end the poll. All my rambling here. Great.
Most of you are almost there.
So glad to see that. Yes.
That 15%, I'm going to go back and look at those that haven't started. No, I'm just kidding.
Yes.
It's a lot. I mean, it's really, I think it's a lot of research if you're not sure.
So unfortunately, I have rambled on too long, and we almost made it to the end. So we do have a separate Word document, so we can share that with those of you that request it. It is, again, it's not authoritative. It's just a generic example footnote with different things highlighted for different areas in the note disclosure that need to be updated and revised as well. And then resources, of course, you've got your GASB CCMA white papers, GFOA best practices, and GFOA's example ACFR. I provided the links to you as well. All right, any final questions that we want to cover?
Yeah, so there is one. Can we use municipal market indices as a discount rate? It's
always an option. You know, there are a number of different options. Again, we and GASB can't tell you what's right or wrong. It can just provide suggestions, and it's what's reasonable. So now we're going to look at something that's reasonable. You know, like in today's market, a 20% interest rate is not going to make sense. You know, but something that's reasonable and has a basis, and you've factored it in, then that's it. There are going to be a lot of different options.
And then another question is, do you recommend having a lease abstract for each lease? Is that what you mean by list?
So when I talk about inventory, in my mind, I'm envisioning an Excel spreadsheet, but it's going to be whatever works for you. But the lease abstract is I know that a lot of new lease agreements, and for those of you that don't know, a lease abstract, a lot of the newer lease agreements have a 1 or 2 page abstract that summarizes all the key components and key provisions of the lease agreement. So that would be something that would be easy. You know, obviously you're going to want to have a place where you have all of your full lease agreements, but that might be something that would be good to embed or include in that lease inventory where there's a reference straight to the abstract. Unless by that question you mean in your spreadsheet or your inventory, you're including all the abstract components in your inventory, that's something that you could include as well. It's going to be whatever works for you to show the trail of what leases do you have out there, either as lessor or lessee, because don't forget, you got to do both sides when you're a lessor or a lessee. And what are the key components, and what's your decision? What is your decision? Is the lease subject to 87? If yes, how did you calculate, you know, what components are going into the calculation of the lease asset or liability? That the actual lease asset or liability calculation, depending on how you design this thing. Doesn't necessarily need to be in that schedule, but something that's going to tell you what, because you're also going to have some that are subject to 87, but then when you determine or set your capitalization threshold, then they may not be material to capitalize. So that's going to be something that you need to include in your component. What's the ultimate decision and why? Why did you conclude that it's not going to be capitalized?
All right, and then there is another question. Where can we get more information on IT subscription-based agreements? And so
Yeah.
not only the GASB, but also the implementation guide?
Yes. So go here to this link, gasb.org, and you can go to statement, is it 96?
Yeah.
So it's pretty straightforward. If you go to this will bring you right to the pronouncement page, and you can scroll down. They're in groups. It's, I forget what it's like, 75 to 100 or something. Click on that. Then you can scroll down and find 96 and click on it. You can download it. It's searchable. And then the implementation guides, of course, are available on that same page as well, on the pronouncements page. And so you can find those as well. And they also have the GARS online, the GASB online, the statements and codification. There's a free version of the GARS, is called. It includes all of the codification. And so that's a good tool as well. The free version that's on there isn't quite as robust as the paid version, but it's definitely has everything you need to see everything in one place. When we look at, as you move forward, the codification, like I always use the codification for things because that includes any subsequent amendments. That's when you're looking at something, that's why we try to stop after the year of implementation. We try to stop referring to something as, like, let's use GASB 68 as an example. We don't call it GASB 68 anymore in the statements, financial statements, because it's been amended subsequently. So it's no longer just statement 68. So that's why we usually refer to the codification or look to the codification, because it's going to include any of the amendments, subsequent amendments.
And then there is one more question, or actually there's a few more. We are a fiscal agent for a JPA. Do we, the city, have to comply with GASB 87 for the JPA?
I don't know if I'm going to answer it the right way, but the JPA, if the JPA has leases, the JPA has to implement 87. So it depends on what components of the JPA are included in your financial statements. Like if it's included as a custodial fund, I'm assuming, I don't know if it's a blended component, I'm assuming it's not a component unit, it's a separate entity. So the separate entity is going to have to implement. So if it has leases, depending on how it's put into your financials, if it's a custodial fund, it doesn't necessarily have to record it may have to record it, but it doesn't necessarily mean you have to include all the note disclosures about it. I think, you really have to look at it.
Yeah, and in this case, they clarified that it's custodial. So like you said.
Okay, so it's a custodial fund. So technically that fund should record anything just like it normally would. If you have any long-term assets or liabilities in that fund, you would, but there may be some ways around it, because definitely in the separate financial statements, it would have to, if it has any, it would have to record those.
Okay, and then how close do your capitalization and lease 87 thresholds need to be? That
is your own decision. We can't give you an answer on that. It's just one of those, maybe it's a good place to start. It's a good place to start to look and make those decisions. And that's why we've been saying you want to establish those thresholds. Again, as Whitney said in her class earlier, it needs to be something reasonable. Now, I had a conversation with a client yesterday. If you're going to set your threshold at $1 billion, no, it's not reasonable, unless you're a $500 billion entity. Maybe even then it doesn't work, but $1 trillion entity. So it's got to be something reasonable that you're setting the thresholds. On the flip side, if your capital asset capitalization policy is everything over $1,000, okay, maybe that doesn't make sense for leases, so but if it's your policy, and that's what you have to design it. What is your policy? Are you going to record absolutely everything, or are you going to set a capitalization threshold that makes sense for your entity? And part of it, that's what I suggest is to first kind of, again, broken record. Get your inventory, get your initial guesstimate of what your gross undiscounted assets or liabilities could be, and then you can kind of see the world and see the population, and maybe that's where you start to determine. It doesn't have to dictate your threshold, but maybe it gives you an idea of what would make sense, you know, of capitalizing.
Okay, and the last question I see is, can we reach out to you if we have questions related to GASB 87?
Absolutely, anytime. Except the end of this week, I'm on vacation.
Okay, that's it. That's all I see.
All right. Thank you, everybody. Sorry I went long and missed a few slides, but yes, if you hopefully you can go through the slides that we did breeze over, and it'll provide some good information for you. And I do want to say that those example exercises really are very basic, and I know it's not going to be, you know, yours are going to be more complex, so you're going to have to look at your transactions and situations. But thank you for your time. Thank you, everybody.
Thank you, Amy. Made it to the end. So, there's an announcement. I forgot to remind everyone that the link to the survey is in the chat. So don't forget to click the link to fill out your survey.
There it is right there.
And if you did it yesterday, you can look in your history if you can't find it, and find that link, because it's the same for each class. You just got to pick the class on the drawdown. And everyone have a good rest of your week, and hopefully we'll see you in person next year. Thanks for taking the time to go attend our sessions this week.
Thank you, everybody.
I forget who's recording now.